When we think about assets or financial tools, it's common to put them into kind of buckets, right? Assets we could use today, assets we accumulate for the future, and then assets that we pass on. But the tool we use, whole life insurance, specially designed for cash value accumulation, could actually be all three: current, accumulation, and legacy all in one. And that's exactly what we're going to talk about today. Putting whole life insurance to work for you and your family and your business all throughout your existence. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money. So let's talk about life insurance as a current asset. As the cash value builds up in your policy, you can borrow against it to pay off debt, to make purchases, to grow your business, to take advantage of opportunities, to invest in various things. The list goes on, but the point is you have access to money today to take care of the issues you're dealing with today. So that makes the cash value portion a current asset.
Exactly. And, when I think about that current asset, I think about, it's almost, for me at least, an automatic savings account, right? So money comes out of my regular checking account, goes into my policy, and it takes time for the policy to become efficient. But once it does, it really gets ripping and roaring. So it's like moving money from my left pocket and putting it in my right pocket. But when I do that, now I have access to it. Number one, it's able to earn uninterrupted compound interest. Number two, I'm able to take advantage of opportunities to earn an external rate of return.
Yes.
And now all of a sudden I have options, whereas when it's in the savings account, I could build up the money and then drain it down, and then I lose all the interest I could have earned.
Yeah.
Here I'm able to take advantage of uninterrupted compound interest, plus I have the death benefit and added benefits like protection that's associated with the life insurance contract, which is really cool and makes me feel a lot more secure and, financially free, and that I don't have to ask permission to access that money. Even though it's a loan, it's a contractual guarantee that I have access to that policy loan. As in, the life insurance contract says, okay, if you have the money available in your policy, you have the right to be able to access it via the policy loan.
Yeah, and that's power. That's control. That's giving an order, not asking permission. So the second type of asset is an accumulation asset, an asset that's deferred into the future. And by that, what we mean is, okay, not only do you have access to this money currently, the current asset, but you also have access to this money in the future. And as it accumulates, and again, life insurance is a long-term type plan, so you're building this cash value, and with the dividends and the interest that you're earning inside the policy, you can utilize all of that money to supplement your retirement income. So that's where the accumulation or deferred part of the assets really start to kick in.
Right, and it's cool because you're able to, slowly build up that money with your monthly or annual income throughout your life for, 20, 30, 40 years. But then, you're able to access it, pay it back, and it grows all along the way. And then ultimately it's time to retire, right? So you have access to that in retirement on a tax-favored basis, right? So you could take all of the money that you put in out tax-free and then access the rest that has accumulated, that interest that's accumulated, via the policy loan and not have any tax consequences for it, which means that you're not going to incur all of those other taxes from having too much income in retirement.
Yeah, that's a great point, because what are those other taxes? State income tax, federal income tax, Social Security offset tax, increased Medicare premium. All of those taxes erode the efficiency or the effectiveness of our retirement income. And by having money in the insurance policy, you basically have found a way to avoid having to pay those excess taxes.
Right. So normally when you go to retire and you pool money, you build this pool of money in an IRA, a 401k, a tax qualified account, you take it out and then it's on the government's radar, right? So the more money you pull from there, which is where you should pool money, that's where you built it up. So you have to pull it from there. The more money you pull out, the more taxes that you're paying on that money. It's fully taxable as income because it was never taxed yet. Plus, you have to pay those extra taxes the more that you access. So it really puts you in a position where the more you saved, the more you take out, the more you actually pay.
And, we've said it several times over the past several videos, but the question becomes, okay, you're doing something for your future, but are you making any progress?
Right, and I think it all comes down to that control factor. And I know I feel like a broken record. All we talk about is control, but when you're saving in these...
Hey, that's our word.
When we're saving in these tax qualified accounts, they're qualified by the government, right? So that means that the government is in control and determines the rules associated with those accounts. So there's not really a way to be in control of those assets when the government's giving you incentives to save there, so they get to determine the rules.
So now let's transition to the third type of asset, which is a legacy asset. So think about it. You've put money away. You're able to access it currently, the current asset. You're able to utilize the money as an accumulation or deferred asset so you can supplement your retirement income. And then you pass away. And now that's where the magic really happens, because now you get this explosion of value through the death benefit that will pass to your children or your surviving spouse or your business or your named charity. But the key is you have the control as to who actually gets that money.
Exactly. And what else I was thinking is that's really where the recapturing of all that interest paid over the years come into play, right? So
Yeah.
with a normal financial situation, you're giving away interest all along the way. With policy loans, there is interest being paid to the insurance company, but you're able to really recapture that for the future generations in the form of the death benefit because there's no way that the amount of premium paid is going to equal the death benefit in any situation.
That's why it's really important to utilize life insurance, because you get basically $1 doing three jobs or multi-duty dollars, right? You're getting a current asset, a deferred asset, and a legacy asset. All in one.
Yeah, talk about efficiency.
Yeah.
If you'd like to learn more about how to put this process to work for your specific situation, visit our website at tier1capital.com and schedule your free strategy session today. We'd be happy to chat with you. Also, if you like this video, please be sure to check out these two. We picked them out special for you. Don't forget to give us a thumbs up and hit that subscribe button.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.